Hey guys, welcome back to the Bitcoin Fortress podcast, episode 201. It's Sunday, February 1st, 2026. We are at block height 934,624. Moscow time 1279, and fees are 1, 1, and 2 sats per VByte. This was an instructive week because it wasn't just Bitcoin that looked broken. We saw stress everywhere. Crypto, equities, and then on Friday, gold and silver got absolutely nuked. And when very different assets all start selling together, that's usually not a new fundamental truth. It's usually liquidity, it's leverage, it's forced selling, it's the plumbing. So, today's theme is markets are not functioning smoothly. Everything's broken, and Bitcoin is still the exit. So, let's get into it. We'll start out with the news. First segment, Bitcoin macro and liquidity week. Bitcoin breaks below 80,000 amid thin liquidity and risk-off headlines. According to Reuters, Bitcoin fell below $80,000 as liquidity worries mounted and the market repriced on tighter policy expectations, new Fed chairman and all that fun stuff. Also, CoinDesk pointed out how thin weekend liquidity can magnify selling pressure and accelerate a move once key levels break. The weekend effect matters. Fewer buyers, wider spreads, bigger gaps. This didn't feel like new information about Bitcoin, though. It felt like the market has no bids. Just a reminder, Bitcoin is a global liquidity barometer in moments like this. And although I've seen some charts that says global liquidity is rapidly growing and Bitcoin is going in the opposite direction, something just doesn't seem quite right about that narrative. Anyway, in the short run, Bitcoin trades like a risk asset. In the long run, it's still hard money with a fixed supply schedule. So, when liquidity disappears, price discovery turns into price damage. Next up, Reuters talks about Bitcoin sliding as the Fed chair speculation hit the risk assets. Reuters tied the move to speculation around tighter policy, balance sheet posture, and broader risk-off mood. The U.S. being more responsible with the dollar? Could it be? We shall see. Doesn't seem like the money printer is going to be shut off. Let's just say that. Markets are addicted to forward guidance and liquidity, though, folks. And if traders think the next regime means less liquidity, then they dump the most liquid stuff first. Bitcoin is highly liquid, so it gets sold, even by people who claim it's a hedge. That's why Bitcoin is a hedge. It is often a time horizon statement, not a day-to-day statement. Bloomberg emphasized thin liquidity and limited buying interest as Bitcoin slid below 80,000. Limited buying interest is the key phrase. Not Bitcoin stopped working, not Bitcoin was hacked, just the marginal buyer backed away. And price must fall to find the next buyer. And this is how markets clear when the tape is stressed. Moving on to ETFs and TradFi plumbing. CoinDesk reported U.S. listed spot Bitcoin and other ETFs are bleeding nearly $1 billion in a day. ETFs are now a major marginal price setter in the short run. Outflows aren't philosophical, they're mechanical. If the product redeems, the product sells. This is the new GBTC era, except spread across multiple funds. This is a good reminder that ETF demand is not adoption, it's allocation and allocation swings. And as we've talked about a lot before, It's great to support the price when price number go up, and it's not so good when number go down because institutions and folks that are in the ETFs are more than happy to press the button and sell. 4-day outflow streak and big redemptions into Friday. Crypto.news reported a 4-day outflow streak with 509 million of net outflows on January 30th. Outflows into Friday set the stage for weekend fragility. Even if you don't track flows daily, you should track them during panic weeks. This is why the price can feel fake. It's dominated by flows, not by people buying Bitcoin to save. And there's still plenty of them. I did my dollar cost average last week when I got my paycheck, just like I do every 2 weeks. And that's going into cold storage, and it's not coming out. And there's a lot of people like me out there, I'm sure. Value zone talk shows up again. Investopedia covered how some analysts frame a value zone in the mid 70s amid weak ETF flows. I like this framing because it forces honesty. What level brings real buyers back? But also, nobody knows. The market will find it. For long-term stackers, the question isn't, can I time the bottom? The question is, do I have a plan that survives volatility? I guess the other question is, do I have any fiat left to buy the dip? That is the problem when you are all in. Moving on, Washington regulation and quote unquote clarity. DC meetings over the Clarity Act and market structure. Yahoo Finance reported Wall Street and crypto leaders meeting in Washington with the Clarity Act in the balance. Clarity usually means who regulates what and who gets permissioned lanes. TradFi wants rules it can comply with. Crypto firms want legitimacy. Regulators want jurisdiction and surveillance. Bitcoiners should hear more access, but also more KYC gravity. So we'll see. We'll watch as they duke it out. The banks are very powerful, but so are the crypto firms. So it'll be interesting to see how this whole thing lands. But I'm sure it'll be a battle to the end. Senate market structure draft summaries circulate. Lexology summarized an updated Senate Agriculture Committee draft framework. Market structure bills are never one simple rule. They're definitions, classifications, and reporting obligations. The danger is always the same. Broad definitions that turn normal behavior into regulated activity. My take here is that compliance expands and Bitcoiners route around it with self-custody and peer-to-peer tools, which is why you need to continue to educate yourself about those things. Next, the Office of the Comptroller of the Currency proposed rulemaking tied to National Trust Bank chartering. That's from Yahoo Finance. This is one of those boring but huge items. Trust charters are custody gateways. The message is institutional custody is becoming normal infrastructure. This is good because it's easier access for normies, but it's bad because the system is building cleaner choke points. So the value of self-custody goes up, not down. Moving on to banking integration. Financial Times reported Laser Digital is seeking a U.S. banking license and charter path. The story of 2026, everyone wants to plug into the regulated stack. That means more convenience for the consumer, but it also means more censorship surface area. Bitcoin doesn't need banks, but banks want Bitcoin product, and most importantly, Bitcoin fees. Moving on to mining, energy, and network resilience. Hash rate drawdown tied to storms and curtailment. CoinDesk reported a sharp hash rate drop as storms forced curtailment, the biggest drawdown since certain historical shocks. This is miners behaving rationally in real energy markets. Curtailment isn't failure, it's called flexible load. The network doesn't panic, it just simply adjusts. And blocks keep coming, difficulty adapts. This is the most underrated feature of Bitcoin. It's anti-fragile under stress. Hash rate index context. To avoid bad conclusions here, the hash rate index provided broader context in the week's mining environment and trends. Hash rate volatility is not security collapsing. It's an input cost signal and a weather energy signal. The system self-corrects. Hash rate drops, difficulty adjustment goes down, more miners plug in, hash rate goes up, difficulty adjusts up. It's a beautiful thing to watch. Next up, corporate Bitcoin. Strategy adds 2,932 Bitcoin, a total of $264 million purchase. Yahoo Finance covered that purchase last week. Love it or hate it, this is a clean signal. Corporate capital structures are being converted into Bitcoin reserves. It's not price support, it's policy. And the market learns there are buyers who view dips as inventory. This is part of Bitcoin monetization. Balance sheets start behaving like sovereigns. Moving on to Lightning and Bitcoin tech. Lightning bug fixed after a long runway. Protos covered a long-running Lightning bug finally being fixed. This is what real engineering looks like. Slow, careful, public iteration. Not hype, not marketing, actual fixes. Bitcoin's superpower isn't flashy features, it's robustness over time. And the Lightning Network is super important because it allows you to spend your Bitcoin and gives you, although less security than main chain, a lot more privacy than doing transactions on chain. So you keep your money in your savings account, in your cold storage wallet, and then you move it to your Lightning wallet, and then from there you spend. And that is super important. So we want to continue to see the Lightning Network develop and build out, and also the apps become more user-friendly so that you hardly even know that you're using Bitcoin when you're using it. You just scan a QR code, paid, done. And that we're there now with a lot of the Lightning applications, but greater adoption there is key for being able to maintain our privacy in a world that is taking it away every day. Moving on, Amboss relaunches Rails X, Lightning native P2P swaps. Amboss announced Rails X as a Lightning native peer-to-peer exchange layer. Big picture, more exchange-like activity moving toward non-custodial rails. Anything that reduces custodial choke points is directionally bullish for sovereignty. It's early, and user experience does matter, as we've talked about before, but the direction is right. Peer-to-peer, Bitcoin native, censorship resistant. Next segment, let's talk about gold and silver's Friday carnage, a broken market's lesson, if you will. Gold and silver plunge hard on Friday, a historic type move, I think something like not since 1980 or something. Barron's reported gold and silver falling sharply, with silver posting an extreme one-day drop and gold seeing a record-style move in the futures. Market Watch describes silver's plunge as one of the biggest in decades, pointing to frothy positioning and panic unwinds. This is why I wanted to include metals this week. They're supposed to be safe havens. Instead, they traded like leveraged momentum instruments. When everyone is on the same side of the boat, a catalyst hits and you get forced liquidation. That's not gold failed or silver. It's the paper market got overcrowded. And of course, obviously, it's another sign, an obvious sign to me, that the markets are not functioning well. Anyway, this didn't look like price discovery to me. It looked like a margin call. And in margin call, everything goes down. Next, let's talk about paper metals versus physical reality. This is very important. Futures and paper flows dominate short-run price, but physical demand does not set the ticker hour to hour. Same story we've seen in other financialized markets. The derivative tail wags the dog. The lesson for Bitcoiners here: paper claims create volatility and fragility. Self-custody is the antidote. It's true of gold, it's true of silver, and it's true of Bitcoin. If you've got the physical, that's all that matters. I'm also reading about how a lot of the Asian markets, the physical price is much higher because they do settle in physical than the Western price, and there's these huge gaps opening up in price between these markets, and it just, again, all feels like everything is breaking on the paper side. Market structure dysfunction is the week's meta theme. Again, correlations spike when the plumbing breaks. Crypto down, metals down, stocks shaky. We'll see on Monday how they hold up. But it's the same signature. When correlations go to 1, it's rarely everyone learned the same truth. It's everyone needed cash at the same time. Liquidity stress reveals how fragile the system is, and it is fragile. Big takeaway: markets shook, Bitcoin kept producing blocks. You can debate price all day, but the chain kept running, miners adjusted, developers shipped fixes, the system did what it always does, it kept its promises. And if you're dollar cost averaging, congratulations, you're getting some cheap sats. Put them in cold storage, keep stacking. 5-10 years from now, you'll look back and go, man, was I a genius or what? Next up, let's talk about the Bitcoin podcast universe themes of the past week. What kept repeating across the various Bitcoin shows this week? Well, the first one, flows are greater than feelings. People kept circling back to ETF outflows and how the ETFs now dominate marginal price setting in panic weeks. CoinDesk's near $1 billion outflow day story is exactly the kind of data point that fuels this theme. Theme 2, the new macro villain, is liquidity withdrawal. Reuters repeatedly tied the tape to expectations of tighter policy and reduced liquidity, which is exactly what Bitcoin podcasters were reacting to. Theme 3, markets are not discovering prices, they're unwinding leverage. Friday's gold and silver wipeout became a teaching moment well beyond the metals people. If silver can drop like that in a day, I mean, basically the entire Bitcoin market cap in a day, anything can when positioning is crowded. Theme 4, the state is building clarity lanes and choke points. Washington clarity talk came up constantly with the sense that regulation is more about routing activity into surveilled rails than enabling freedom. Theme 5, self-custody is the only lasting alpha. Whether it was ETF plumbing, custody lanes, or forced liquidation weeks, the repeated moral was, if you're building a life raft, don't rent it out. The theme of the week wasn't Bitcoin is risky. The theme was the system is fragile. Bitcoin just shows you the truth faster. Featured post of this week on Substack, on the Bitcoin Fortress Substack, is Bitcoin and the Oregon Trail. Kind of a fun one. Link in the show notes to all the articles I covered, as well as this and the books. Scarcity forces trade-offs, bullets and food, and then sats and time now. Self-custody is packing your own wagon. No password reset, no rescue team. Exchanges are river crossings, convenient but dangerous if you don't respect risk. The graveyard is real. Leverage, bad ops, lost keys, tombstones everywhere. In 2026, the frontier isn't land, it's money. Don't die of dysentery. Don't get rugged. If you want to go deeper, check out my books, Bitcoin Fortress, A Simple Guide for Beginners, Bitcoin Retirement and Estate Planning, and The Bitcoin Lifestyle. Links in the show notes, all available in multiple formats on Amazon. Well, folks, this was a messy week, but also a clarifying one. Markets looked fragile. Liquidity ruled everything. Gold and silver reminded everyone what forced selling looks like. And Bitcoin, well, it did what it always does. Blocks kept coming, tick-tock, next block. So, with that, stay humble, stack sats, and pack your wagon carefully. I'll talk to y'all next week. Bye-bye.